Welcome to Meta Storm Cooper. Now let's begin with our top story. The latest report from the U.S. Department of Labor brings some encouraging news about the American job market. For the week ending March 28, 2026, the number of first-time applications for unemployment benefits fell to 202,000. That marks a drop of 9,000 from the previous week after a slight upward revision in those earlier numbers. This figure came in noticeably better than what many analysts had expected, which was around 212,000. This development suggests that layoffs across the country are staying quite low, even as the broader economy faces some uncertainties. It paints a picture of a labor market that continues to show real resilience, with employers not rushing to cut jobs in large numbers. Let me walk through what this data actually tells us, step by step, and why it matters right now. First, a quick reminder on how these numbers work. Initial jobless claims represent new filings for unemployment insurance in a given week. They serve as one of the most timely signals we have about the pace of layoffs in the economy. When these claims stay low and stable, it generally points to employers holding on to their workers rather than letting them go. In this latest week, the decline to 202,000 puts the figure close to some of the lowest levels seen in nearly 2 years. That is noteworthy because it comes after a period where claims had hovered a bit higher in recent weeks. The previous week's reading was revised upward to 211,000 tones. So the drop feels even more pronounced once those adjustments are factored in. To smooth out week-to-week ups and downs, economists often look at the 4-week moving average. That measure fell by 3,000 this time, landing at 207,150. It is another sign that the underlying trend remains favorable, with new claims trending gently downward rather than spiking. On the continuing claims side, the number of people who are already receiving unemployment benefits, the picture is a little more mixed, but still largely steady. For the week ending March 21st, continuing claims rose by 25,000 to 1,841,000. The insured unemployment rate held steady at 1.2%. While there was a small increase, the 4-week average for continuing claims actually declined to 1,838,750, which is the lowest it has been since late September 2024. What does all of this add up to? It reinforces the idea that the U.S. labor market is not seeing widespread job losses right now. Layoffs are remaining contained, and most people who do lose their jobs appear to be finding new work relatively quickly. That keeps the overall flow of people into unemployment insurance programs from growing too much. Of course, no single week of data tells the whole story. The job market has shown some softening in other recent reports. For example, the February employment situation showed an unexpected drop in payrolls, with the economy shedding jobs and the unemployment rate ticking up. Yet these claims figures act as a counterpoint, suggesting that any slowdown has not translated into a surge in firings. Why might layoffs be staying low, even amid some economic headwinds? Several factors appear to be at play. Many companies seem to have adopted a cautious approach to hiring and firing over the past couple of years. After the intense labor shortages of the post-pandemic period, employers learned how difficult and expensive it can be to replace workers once they are gone. As a result, a low-hire, low-fire dynamic has taken hold in many sectors. Businesses are being more selective about adding staff, but they are also reluctant to let people go unless absolutely necessary. Productivity gains, partly driven by technology and artificial intelligence, may also be helping. Some firms are finding ways to do more with the workers they already have, reducing the pressure to cut headcount during periods of slower growth. At the same time, certain industries continue to see targeted reductions. Tech companies, for instance, have announced notable job cuts in 2026 as they restructure and invest more heavily in AI. Retail, manufacturing, and media have seen some high-profile layoffs as well. But these moves have not spilled over into a broad wave of job losses nationwide. The claims data suggests that, on balance, the labor market is absorbing these changes without major disruption. Looking at the bigger picture, the unemployment rate has been relatively stable in recent months, hovering around 4.4% in the latest monthly figures. That is still near historically low levels by long-term standards, though it has edged higher from the very tight conditions seen a couple of years ago. Job openings have cooled off from their peaks, but they remain above pre-pandemic averages in many areas. Wage growth has moderated but continues to outpace inflation for many workers, supporting consumer spending. The Federal Reserve is watching all of this closely as it considers the path for interest rates. Low and stable jobless claims give policymakers some confidence that the labor market is not deteriorating rapidly, which could allow them to take a measured approach on rate decisions. At the same time, any signs of rising claims in the coming weeks could shift that calculus if they point to weakening demand for workers. It is also worth noting the external pressures that could influence the job market going forward. Geopolitical tensions, including developments involving Iran, have added uncertainty around energy prices and global supply chains. Higher costs for fuel and certain goods could squeeze businesses and households alike. If those pressures build, they might eventually lead to more cautious hiring or even some additional layoffs in affected sectors. Consumer confidence and spending will play a key role here. As long as people feel reasonably secure in their jobs and their wages keep up with living costs, the economy has a better chance of navigating these challenges without a sharp downturn. State-by-state variations exist, as always. Some regions with strong growth in sectors like healthcare, construction, or energy may see even lower claims, while others tied more closely to manufacturing or retail could experience more volatility. The national numbers, however, show a consistent pattern of limited layoffs. Unadjusted claims data provides another lens. In the latest week, actual, not seasonally adjusted, initial claims came in at 184,245, down from the prior week. Compared to the same week a year earlier, the figures remain favorable. Federal programs in special categories, such as claims from former federal employees or newly discharged veterans, make up only a small portion of the total and did not show unusual movement. Overall, this report adds to a narrative of a labor market that is cooling gradually but remains fundamentally solid. It is not the red-hot environment of a few years ago, but it is also far from flashing warning signs of recession-level job losses. For workers, the message is one of relative stability. If you are employed, the odds of an unexpected layoff appear low based on these trends. For those seeking work, opportunities still exist, though competition may be a bit stiffer than during peak labor shortages. Employers, for their part, continue to operate in an environment where retaining talent makes strategic sense, even if expansion plans are more measured. Looking ahead, the coming weeks of claims data will be important to watch. A sustained move below 200,000 would be even more reassuring. Conversely, if claims start climbing toward 220,000 or higher on a consistent basis, it could signal that the softening seen in other reports is beginning to translate into more noticeable job cuts. Economists will also be paying close attention to the next monthly jobs report for March, which should provide a fuller picture when combined with these weekly indicators. In the meantime, this drop to 202,000 offers a moment of reassurance. It highlights that despite various challenges facing the economy, from inflation concerns to international tensions, the pace of layoffs has not accelerated. The American job market continues to demonstrate underlying strength and adaptability. That resilience matters not just for statistics, but for the millions of families who depend on steady employment to pay bills, save for the future, and maintain their quality of life. When layoffs stay low, it supports broader economic confidence and helps keep the cycle of spending and growth intact. Of course, the economy is complex and risks remain. No one can predict with certainty how trade policies, energy markets, or technological shifts will evolve over the rest of 2026. But for today, the data suggests that the foundation of the labor market, measured by how few people are being let go, is holding up well. This kind of report reminds us why these weekly figures matter so much. They offer an early read on conditions that can affect everything from Federal Reserve policy to household budgets. And in this case, the read is cautiously positive. Layoffs are not picking up speed. As we move deeper into the year, the interplay between hiring, firing, wages, and inflation will continue to shape the outlook. For now, the latest numbers on jobless claims provide a steadying influence amid other mixed signals. The labor market has surprised observers many times in recent years, proving more durable than some forecasts suggested. This latest decline in claims fits that pattern of resilience. It is a development worth noting, even as we keep an eye on the full range of economic indicators in the weeks and months ahead.